I'm sure you've seen plenty of comments online that share-based compensation or SBC for a certain company is too high, shareholders are being diluted, and therefore it needs to be reduced. Comments like this imply that reducing it is not only easy, but it's also beneficial for the existing shareholders. This is not necessarily true, and let me elaborate. SBC is a powerful tool in the corporate world, but oftentimes it is misunderstood by retail investors. Despite its bad reputation for diluting shareholders, it plays a big role in aligning the interests of the shareholders and the employees. Here is a very simple example. Imagine that you have a business idea and you need a website for it. Your friend Mike is a web development legend, but you're a little bit short on cash. For that reason, instead of paying him in cash, you offer him a stake in your new venture. This is a classic example of SBC. You've diluted your ownership, but avoided paying any cash, and you've aligned Mike's interest with yours. So the risk and reward is now shared by both of you. You're on the same team. Of course, this also means that Mike will evaluate the chances for its success before accepting your offer. In public companies, it is common that part of the compensation of the top most valuable employees and the top management is in the form of shares or options. Similarly to the previous example, this aligns their interest and the interest of the shareholders, reduces the cash outflows, and as we will see later, helps reduce employee turnover. But let's go back to the question, how can SBC be reduced? The only way is, well, to compensate the employees or Mike in cash. For unprofitable companies, this means they will be losing even more cash and might need to raise additional capital, which leads to dilution anyway. Not only that, but there are more legal and transactional costs incurred along the way, and the employees have no ownership in the company, so they might be less invested in its success. Reducing SBC isn't free, and for unprofitable companies, it is often just a bad idea. The concept of share-based compensation isn't new. It emerged as a way for early-stage unprofitable companies, especially in technology and startups, to attract talent when they couldn't afford high salaries. Over the years, it has evolved into a standard practice in many industries, seen as a way to align the interest of the employees with the interest of the shareholders. This alignment is basically based on the belief that if employees own a part of the company, they will be more invested in its success. However, SBC can be destructive to the existing shareholders. It might lead to short-termism if the performance goals set favor short-term results over long-term sustainability. This could result in underinvestment, cost-cutting, and even taking risky decisions and accounting fraud. In addition, the market volatility could impact morale, as shares and options are less reliable than cash. Take a look at Zoom. The market was irrational during the pandemic, pushing the share price to unreasonable levels. If you were an employee of the company and were given stock options to buy shares of Zoom at 3, 4, maybe $500 per share, well, there is not much value there today given the share price. The opposite extreme is also something that could bring a challenge. Take a look at Nvidia. Its share price skyrocketed over the last 5 years, and now many employees find themselves with options or shares worth millions of dollars. Although this is great for them, and many will choose to retire early, it brings a new challenge to the management, which is how to retain this pool of talent, how to keep it motivated, and in the worst case scenario, how to replace it. Let's go over the 4 most common types of SBC, starting with RSUs or restricted stock units. This type of compensation grants employees shares that vest over a certain period of time. For instance, you might receive 100 shares if you stay in the company for the next 3 years. This period of 3 years is called vesting period, and it not only incentivizes retention but also ensures that you do your best and add value to the company, as you directly benefit from it. You might say, well, this is just 3 years, so there is no incentive to stay after that. Why wouldn't I just sell the shares after 3 years and leave? Plans of this kind start every year, so there are always shares that are vesting, creating a continuous incentive to stay. Second, stock options. This gives the employees an option to purchase a share at a predetermined price. This price is known as the exercise price. For example, as I'm recording this video, the share price of Meta is around $500. Imagine that today you're given the option to buy a share of Meta for $500. You might ask, well, that doesn't make sense. That is the market price. I don't need this option. I have this option already. But the market price will change tomorrow and the day after that, the day after that. The exercise price of your option remains the same. The higher the share price, the more valuable this option is. So if the share price goes up to $1,000, you can still buy a share for $500. Same as the previous example, if you leave the company, the option is no longer available. However, the stock options have expiration dates and they do not last forever. Next, we have employee purchase plans. These plans allow the employees to buy shares at a discount, typically ranging between 5 and 15%. However, the shares must be held for a certain period of time before the employee can sell them. This time frame can range from 6 months up to a few years. Lastly, performance shares. As the name suggests, these are only granted if certain performance goals are met. These type of shares are more common for executives and managers, and the metrics are oftentimes financial, such as earnings per share or return on capital employed, or in some cases the market cap of the company. At the end of the day, share-based compensation is a tool that can be used to create value for the existing shareholders, or it can be used in a way that destroys value. Understanding it is crucial for both the companies, but also the investors to navigate through its complexities. Now, from a cash point of view, well, it doesn't really involve that, right? It doesn't have any cash outflows, but it does have an associated cost. And the two factors that are required to determine this expense that is recognized on the income statement are the fair value of the compensation and the timing. The fair value is typically determined on the grant date and it remains unchanged regardless of the subsequent share price movement. For companies with high share price volatility, this means that the recognized expense may not accurately reflect the true dilution. However, the annual reports of the public companies include a note on the share-based compensation that provides all the inputs necessary to calculate the fair value. Once this fair value is determined, it is typically expensed over the vesting period. For example, if the vesting period is 3 years, 1/3 of the fair value is recognized as an expense each year. Accounting rules allow companies to estimate what percentage of the employees will leave the company throughout this period and include this input when calculating the expense. There is one metric that we need to bring into this conversation that is heavily impacted by SBC, and that is free cash flow. This formula is very simple, it's easy to understand. Free cash flow is equal to the actual cash that the business generated from its operations minus the cash that was invested in capital expenditures. Since SBC is not a cash outflow, it isn't included in this formula. So if you're using free cash flow as a metric for profitability, it will be overstated as this dilution isn't taken into account. Morgan Stanley shared research that for the Russell 3000 index, which represents the 3,000 largest public held companies incorporated in the US, SBC ranged between 2% of the operating cash flow for companies in the utility sector up to over 20% for companies in the IT sector. So if you're analyzing and valuing a company, it is quite clear that you cannot just ignore this. So you have two options. Number one, include the impact of SBC in your model and treat it as a cash expense, or number two, ignore it as it has no cash impact, but ensure that the future dilution is reflected in the numbers of shares outstanding. Now, do you see that little button down there that says subscribe? If you haven't subscribed to the channel and you enjoy videos of this kind, consider doing that. After all, it is free and it helps the channel grow. As always, thank you for following this video until the very end. See you in the next one.